Hi, and welcome to an early global view on Tuesday, November 10th, 2015. It is currently 6:45 a.m. U.S. Central Time, and it's been quite an interesting couple of previous days in the market. With last week's ecstasy for the equities and suffering everywhere else on the U.S. employment report. But then on Monday, the equities get punished pretty badly, and we think we have a reason why, and that was the OECD, Organization for Economic Cooperation and Development, semi-annual outlook. And we'll get back to that momentarily. So we have to ask, what does all this mean to the markets? And on present form, the S&P that got knocked so significantly yesterday, pretty much right from the opening, is currently off $6 at 2067. So that puts it down near yesterday's trading low down at 2064. But that really doesn't bother us quite so much because the bigger lower support is down in here at about the 2060 to 58 area. And as a matter of fact, you can see the importance of that going all the way back to the dip right after the FOMC statement, going back to 2 weeks ago on Wednesday. So that 60 to 58 with a tolerance maybe to this 56 trading low, pardon me, is very important, because if that doesn't hold, the market's back below the worst level seen after what was still a fairly accommodative, more accommodative than some people would have imagined, FOMC. Now, unfortunately for the bears, there's some big support that was generated on the way up with breakouts and gaps between 2050 and 46, and we'll be keeping an eye on that as well. You'll see more of that in the intermediate term view. And the market's now, since last week's highs, in a downward channel. That's around 2084 early today. Out into the close, it's 2075. So even though it looks gradual on the short-term chart, it's pretty aggressive. And classically, even if this market's turning bad, it will tend to not stay down on the first sell-off. If it holds variously into 2060 or even 2050, one way or another, it's going to break up out of this channel and head up for maybe a one last test of higher levels, up around 2090 or even 2100. So we'll be keeping a close eye on how this evolves, but it is acting toppier than in a while. And for right now, the hourly MACD being out below the lower runaway band still favors the bears to come back in and pressure it a bit more this morning, and we'll see how well they do with that. And again, the higher resistances are indeed up around 2080 to 75 that held going back to the activity last Friday, but was knocked out this morning. And that gets back to that OECD composite leading indicators, OECD semi-annual outlook weakness. And the higher resistance above that, of course, has been 2100 for a while, even in spite of this minor leakage pushing out above it last Tuesday. And that pretty much does it for the short-term view of the S&P 500.